Can you really start investing with just $100? Absolutely. Imagine this. Every dollar you save is a seed. You plant these seeds in the fertile soil of the investment world, and over time, these seeds begin to sprout, growing into sturdy trees that bear the fruit of financial security and prosperity. No matter how small the seed, the potential for growth is immense, and this is the power of investing. Perhaps you've heard of the term compound interest. This is the process by which your investment grows not just from the initial amount you put in, but also from the earnings that accumulate over time. It's the snowball effect in action. The more your money grows, the bigger your snowball gets, and the quicker it rolls down the hill, gathering even more snow. Let's say you start by investing just $100. If you were to add just $25 every month, and your investment grows at an average rate of 7% annually, a typical average return from the stock market, in 20 years, you'll have accumulated over $20,000. And the best part? More than half of that sum comes from the growth of your investment, not from your pocket. That's why even a small sum like $100 is not something to scoff at. It's a stepping stone, a launch pad to greater financial heights. It's a way to cultivate discipline, to learn the ropes, and to start making your money work for you. Investing is not just about making money, it's about creating a secure future for yourself and your loved ones. It's about having the freedom to make choices, to take risks, and to live life on your terms. It's about building wealth, yes, but more importantly, it's about building a life you love. So can you start this journey with just $100? Absolutely. It's not about the size of the seed, but the care you take in nurturing it. With as little as $100, you can kickstart your financial journey. Let's dive into the process. The first step in your investment journey is setting up an online brokerage account. Not as daunting as it sounds, is it? Imagine it as your personal gateway to the bustling world of financial markets, where you can buy and sell investments at your fingertips. So where do you start? Well, you need to pick a reputable online broker. Firms like Fidelity, Charles Schwab, or E*Trade are great places to begin. These platforms are renowned for their robustness, reliability, and user-friendly interfaces, making it easy for novice investors to navigate the financial seas. You might be wondering, what's the catch? Must be a big deposit, right? Not necessarily. Many of these brokers offer accounts with no minimum deposit required. That's right. You can start with as little as you want, even your hard-earned $100. The process to open an account is straightforward. You'll need to provide some basic personal information, choose the type of account you want, and agree to the terms and conditions. A few clicks, a bit of typing, and voila, you're in. Once your account is open, you'll have access to a wide array of investment options. Stocks, bonds, mutual funds, you name it. This is where the fun begins, where you get to decide what kind of investor you want to be. Are you a risk taker, ready to dive into the volatile world of individual stocks? Or perhaps you prefer the steadier journey of index funds or ETFs. The choice is yours. Now remember, this is your investment journey, and every journey needs a plan. Your online brokerage account is your tool, and you're the craftsman. Use it wisely. Research your options, understand the risks, and make informed decisions. And don't worry, you're not alone in this. These platforms offer a wealth of resources to guide you along the way. With your online brokerage account ready, you're set to start investing. So get ready to take the plunge, because your financial future starts now. For beginners, using a robo-advisor can simplify the investment process. You might be wondering, what exactly is a robo-advisor? Well, a robo-advisor is a digital platform that provides automated, algorithm-driven financial planning services with little to no human supervision. It's like having a personal finance manager at your fingertips, 24/7. Robo-advisors are designed to make investing as simple and accessible as possible. You don't have to be a Wall Street guru to start investing. These platforms take into account your financial goals, risk tolerance, and investment horizon to create a personalized, diversified portfolio for you. Let's break it down. When you sign up for a robo-advisor, you'll typically be asked a series of questions. These questions are designed to understand your financial situation, your goals, and your appetite for risk. Based on your answers, the robo-advisor will recommend a portfolio of investments that aligns with your needs and preferences. The beauty of robo-advisors lies in their automation and simplicity. Once your portfolio is set up, the robo-advisor takes care of the rest. It will automatically adjust your portfolio to keep it aligned with your investment goals and risk tolerance. This process, known as rebalancing, is crucial to maintaining the desired level of risk and return in your portfolio. Moreover, robo-advisors often come with lower fees than traditional human advisors. This is because they use algorithms to manage your money, which eliminates the need for a human advisor. This can be a cost-effective way to start investing, especially if you're starting with a smaller amount. Platforms like Betterment and Wealthfront have made a name for themselves in the robo-advisory space. Some of these platforms even have $0 account minimums, making it even easier to get started. Remember, every investment comes with its fair share of risks, and it's important to do your research before diving in. A robo-advisor can be a great tool for beginner investors, but it's not a one-size-fits-all solution. With a robo-advisor, you can automate your investments and focus on the long term. Consider a robo-advisor as your partner in this investment journey, helping you navigate the financial market with ease and confidence. With $100, a smart investment choice can be low-cost index funds or ETFs. Think of index funds and ETFs as a basket of different stocks or bonds. Instead of putting all your eggs in one basket by buying a single stock, you're spreading your investment across a wide range of companies or bonds. This is what we mean by broad market exposure. Let's say you invest in an index fund that tracks the S&P 500. What you're doing is buying a small piece of each of the 500 largest companies in the United States. You're not just relying on one company to do well, you're betting on the overall growth of the market. That's the beauty of index funds and ETFs. They offer instant diversification, which can reduce your risk. Now let's talk about costs. When investing, it's not just about how much you make, but also how much you keep. High trading fees can eat away at your returns, especially if you're starting with a small amount like $100, and that's where index funds and ETFs shine. Because they're passively managed, meaning they simply try to mimic a specific index or sector of the market, they typically have much lower fees than actively managed funds. Another benefit is that you can buy and sell ETFs throughout the trading day, just like stocks. This provides flexibility if you need to make a trade quickly. Index funds, on the other hand, are traded only at the end of the trading day, but they often have lower expense ratios than ETFs, which can save you money in the long run. So, whether you choose an index fund or an ETF depends on your personal preferences and circumstances. But either way, you're making a smart move by investing in a diversified portfolio with lower costs. Remember, investing is not about getting rich quick. It's about growing your wealth steadily over time. And investing in index funds or ETFs can provide a solid foundation for your portfolio. Fractional shares can make investing more accessible no matter your budget. So, what are fractional shares? As the name suggests, they're just pieces or fractions of a full share. This means you don't need the full share price to own a piece of your favorite companies. For instance, if a share costs $500 and you only have $100, you can still buy a fifth of a share. This opens up a world of opportunity. Some of the most successful companies have stocks that are quite expensive, but with fractional shares, you can invest in these companies without breaking the bank. This is especially beneficial for beginner investors who might not have a large amount of capital to start with. So, don't let a high stock price deter you. With fractional shares, you can start investing in the companies you believe in, regardless of their share price. Fractional shares can open up new investment opportunities, even with just $100. One of the keys to successful investing is consistency, and automation can help you achieve that. Now let's talk about how you can automate your investments. Automating your investments means setting up regular automatic transfers from your bank account to your investment account. This can be as little as $25 per month or as much as your budget allows. The beauty of automation is that it happens without you needing to lift a finger. Why is this important, you might ask? Well, it's all about creating a disciplined investment approach. When you automate your investments, you're committing to investing a set amount on a regular basis, regardless of what's happening in the market. This is a strategy known as dollar cost averaging, and it's a tried and true method for building wealth over the long term. You see, the market fluctuates. It goes up, it goes down, and it can be tempting to try and time your investments to take advantage of these fluctuations. But the truth is, even the most experienced investors struggle to consistently time the market. By automating your investments, you're effectively taking the emotion out of the equation. You're not second-guessing whether now is the right time to invest. You're not holding off because you think the market might drop next week. You're investing consistently, come rain or shine. This approach also helps you take advantage of compounding. Albert Einstein once called compound interest the eighth wonder of the world. He said, "He who understands it earns it, he who doesn't pays it." Compounding is the process by which the earnings on your investments begin to earn money themselves. It's a snowball effect that can lead to significant growth in your portfolio over time. So, how do you set up automatic transfers? Well, most online brokerages and robo-advisors make it pretty straightforward. You'll need to decide on the amount you want to invest each month, then set up a recurring transfer from your bank account. Automating your investments can help you stay on track and avoid attempting to time the market. It's a simple yet powerful tool in your investing arsenal, so why not give it a try? In investing, patience truly is a virtue, and so is diversification. Let's put it this way, investing is like planting a garden. You can't just plant one seed and expect a lush garden overnight. It takes time for that seed to sprout, grow, and finally bloom. In the same vein, investments need time to grow. This is where patience comes into play. When you invest, you're not just aiming for immediate returns. You're also banking on the power of compounding, where your returns generate their own returns. Over time, this can lead to exponential growth. Now imagine if you've only planted one type of flower in your garden. Sure, it might look nice for a while, but what happens when a pest comes along that particularly loves that type of flower? Your entire garden could be wiped out. This is where diversification comes in. By spreading your investments across a variety of asset classes, sectors, and geographical locations, you reduce the risk of losing everything if one investment performs poorly. With a starting amount of $100, it may take some time to build sufficient funds for meaningful diversification. But fear not, this is where broad equity index funds come to the rescue. These funds give you exposure to a wide range of stocks, providing a level of diversification that would be difficult to achieve on your own. As your portfolio grows over time, you can start branching out into other asset classes like bonds, real estate, or even commodities. This further diversifies your portfolio, spreading the risk and increasing the potential for gains. But remember, diversification isn't just about spreading your investments thin, it's also about balancing risk and reward. You want to invest in a variety of assets that have different levels of risk and return potential. Remember, investing is a marathon, not a sprint. Diversify and give your investments time to grow. Just like a garden, a well-diversified portfolio needs time to flourish. So, plant your seeds, tend your garden, and watch as your investments bloom. When it comes to investing, knowledge is power. It's the fuel that drives your financial journey forward. It's not just about throwing money at a stock or a fund and hoping for the best. It's about understanding what you're investing in, the risks involved, and how it fits into your broader financial goals. Learning about investing doesn't have to be a chore. There are countless resources out there, from books to online courses, podcasts to forums. Many brokerage firms offer educational tools and resources to their customers. Use them. They're there to help you make informed decisions. Investing is a lifelong journey, and so is learning about it. As you grow as an investor, your knowledge should grow with you. It's not a sprint, it's a marathon. Remember, the most successful investors are not necessarily those with the most money, but those with the most knowledge. Invest in your knowledge, and you'll be investing in your financial future. Investing doesn't have to be intimidating or complicated. And you've just seen how. Starting with a mere $100, we've journeyed through the process of opening an online brokerage account, considered the value of robo-advisors for beginners, explored the world of index funds and ETFs, and discovered the power of fractional shares. We've also discussed the importance of automating your investments, the value of patience and diversification, and the immense benefits of investing in your own financial knowledge. The key takeaway is this: start investing, however small the amount may be. Be consistent, patient, and let your money work for you over time. In the world of investing, every little step counts, and each step you take brings you closer to your financial goals. Remember, the journey of 1,000 miles begins with a single step. So take that step today. And don't forget to like, share, and subscribe to our channel for more investment insights.